My name's Ethan Braid. Today we're going to talk about why life insurance is not a good retirement investment. The primary reason is that the fees are extreme. I'm going to show you a simple way to calculate the actual fees in your life insurance policy. I'm confident that after you see the fees in your life insurance policy, you will not consider this to be a good investment for your retirement. The easiest way to calculate the hidden fees in your life insurance policy is to request an in-force illustration for your policy. You want to request the illustration with no further premiums paid. And the reason I recommend this is because it makes it very easy for you to gauge the amount of fees that you're paying. You can quickly see the impact of fees on your investment in the policy if you aren't making any more premium payments. It will become very apparent the amount of fees that you're paying. And it doesn't matter what type of life insurance you have. You could have whole life, you could have variable universal life, index universal life. It really doesn't matter. They'll all function the same way. You first need to request an illustration and ask your agent, your financial advisor, to have no further premiums paid, and that will give you some real insight into the fees that you're paying. Let me show you an example. Here is an illustration for a $5 million second to die life insurance policy that was issued to a couple who were 56 and 60 years old when they took the policy out. The annual plan premium is $42,652. Total premiums paid $469,169. There have not been any withdrawals or loans on this policy, and the guaranteed return is 3%. Now, whenever you look at a life insurance illustration, I think that the best thing you can do is to first review the guaranteed values column. This is what you can truly count on. The guaranteed values will show you exactly what the policy can earn and also what the maximum costs are or could be in the policy. And when we look at this, right away, something should jump out at you. Notice that the accumulation value of $354,910 is less than the total premiums paid in the policy of $469,169. And why is that? That is because the policy has been earning less than the fees that the couple has been charged. Now keep in mind, they've been in the policy for over a decade and they're still underwater. Not a good investment, obviously. Now, I've run this illustration at no further premiums paid so that we can quickly see the impact of fees on the accumulation value, i.e. your investment component of the policy. And look how fast our $354,000 deteriorates. It only takes a couple of years and we're at zero. And that is because the fees are massive. If you look at age 72 and 76 for this couple, you see that they have just over $100,000, and the following year, all of their money is gone. And that is because at age 72 and 76, they're paying over $100,000 of fees and costs inside this life insurance policy. The other thing that I think is really important for people to consider when you look at these products is the difference between the cash surrender value and the accumulation value. This policy has been in force for 12 years, and there is nearly $80,000 of difference between the $354,910 accumulation value and the $276,560 cash surrender value. And why is that? That is the clawback that the life insurance company would impose on you if you were to surrender this policy. In other words, they've paid roughly $80,000 to the life insurance agent, i.e. financial advisor, who sold them this product. And if the couple were to cash out, the life insurance company would need to recoup that commission. And that is why you see a big difference between cash surrender value and accumulation value. Now that we've reviewed the guaranteed values column of this life insurance illustration, let's look at the non-guaranteed values column. Whenever you get a life insurance illustration, there will be two columns. There will be the guaranteed values, and then there will be the non-guaranteed values. The non-guaranteed values are the current interest rates that the policy is earning in the current cost structure. Looking at the non-guaranteed values column of the illustration, a couple of things stand out. One, it's still a bad investment. It's been 12 years and the accumulation value is still less than the total premiums paid in. Two, there's still a very large surrender charge. Three, the interest rate being earned is the same. However, there is a little bit more accumulation value, and the accumulation value is deteriorating at a slower rate. And the reason for that is that the costs under the non-guaranteed values column of the illustration are not as high as the maximum costs that can be imposed under the guaranteed values column of the illustration. To calculate the total fees that you are paying in a life insurance policy, you simply need to look at the year-over-year change in the accumulation value. In this case, we have $376,107 as a starting value. We should earn 3% in interest, which would be $11,283. And we would expect 12 months later to be at $387,390 if we added our accumulation value plus the interest earned. But instead, we are at $373,353. And the difference between these two numbers is the fees that have been taken out of the contract. In this case, $14,037 have been paid in fees. This is nearly 4% when considered as a percentage of the assets in the contract or your investment in the contract. It's very difficult to make money on an investment when you're paying nearly 4% per year in fees on the investment. Now, if you look at the illustration for your life insurance policy, you are likely to find that as you get into your late 70s and into your 80s, your cost for the insurance, when taken as a percentage of the assets, i.e. the investment, is probably going to be more than 5%. And it could be as high as 6%, 7%. I've seen some as high as 10%. And that is why life insurance is not a good retirement investment. As you get older, the cost skyrockets, and it's nearly impossible to grow your wealth when the cost as a percentage of your investment is at 5% or higher. Now, life insurance is a critical financial planning tool for most families. Most families need it. Not everybody, but most families need it. And you should buy life insurance for the death benefit and the death benefit only. You buy life insurance to pay off a mortgage if you still have one and you were to pass away, to help your heirs, to pay off college educations, things like that, but never buy life insurance as an investment. Over the course of my career of 25 plus years, I have met with over 300 wealthy families, and I have reviewed hundreds of life insurance policies and illustrations. And I can tell you that I have never seen a variable return life insurance policy product like IUL, VUL, or UL perform as illustrated when it was originally sold. And the reason for this is that returns tend to be poor and fees are very high. Life insurance is simply not a good retirement planning investment, in my opinion. So I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.